Okay, welcome to episode 14. So I'm just going to cover moving averages and the moving averages I use and why I use those moving averages. So you can see I use the 10 and 20 EMA. So I have played around with a few moving average variations, which I will obviously show you them. But the reason why I've stuck with the 10 and 20 is for me, they provide the most clarity and aid the way that I trade the best. So we're looking at the monthly chart right now. You can see we're in a bearish trend. You can see the 10 and the 20 act as dynamic support and resistance. So that's how I use the moving averages. They let me know the high probability areas for shorts on the monthly chart. So you can see 1.175 was a great area for shorts, 1.155 here, 1.13. So you can see right now we're breaking above. So how do I assess the charts right now? Right now we're breaking above our 10 EMA and we're heading up to our 20. So the 20 is a calculation of price 20 days in the past. So that's basically what it is. So this is a forecast of if price gets higher than 1.12838. Let's see if I can show the line. Yeah, so if price gets above 1.12840, say, give or say, then that is higher than price was in the past. So what that's indicating is we are potentially reversing on a higher time frame. So that's a change in actual trend. If we go down into our weekly chart, then you can see I like to know the shifts in the market so I can keep my bias aligned. So you can see here we are trading bullish. Once we broke out, had that gap, all bullish. Even when we pulled back, moving averages still didn't cross over, acted as dynamic support and resistance. Our crossover was around 1.125, and you can see we've been trending down ever since, just going lower and lower and lower and lower on the euro dollar. But now you see we haven't quite crossed over. Oh, yeah, we've just had a cross. So we've just crossed over bullish now, and you can see price has made that higher low, rejected off 1.1.0. So we're seeing different characteristics in price than we saw previously. When we go that into our daily chart, so that you can use the moving averages. Me, like I said, I more use it for what side of the market to be on. It's not the be all and the end all, but you can see in this nice downward pattern here, like we said, we had this nice downtrend on euro. You can see your moving averages is just letting you know that we're trending bearish. Price is bearish. We've got the red on top of the black, even when we went above price, which lets you know that's a relative overbought environment. But you can see, let me just put that back on. But you can see when price broke out. So let me just do the top line. So you can see when price broke out, we had a bullish crossover. So that means black went on top of red. So we had a bullish crossover and you see price traded up. So even trading that crossover here would have given you nearly 180 pips. We then had that double top, price crossed over bearish. Even on that bearish crossover, gave you another 100 pips. Consolidation. So moving averages, I don't take any notice of them in a range market. They're no use to you in a range market. Only when price starts to trend. And you can even see when we made that higher low here, moving averages just crossed over. And even though we dipped below the moving averages, we're still bullish. So for me, that lets me know my sentiment still should be bullish. When the lower time frame you drop, obviously less accurate price gets. But for me, I still like the 10 and 20, how they react to price. The lower you go, they act as nice dynamic support and resistance, as you can see. Even in this nice downtrend here, the 10 and 20 acted as great dynamic support and resistance. And adding into our trading strategy anyway, once you had that price broke above that resistance, moving averages crossed over and we could have taken a long trade anyway. You see, even with here, price broke through the support, moving averages crossed over, we can take that short. So when it does align with your edge, it's a beautiful thing. So I don't really want to overcomplicate it too much. I was going to show the other variations, but I might as well. Other variations is say the 20. I only use two at a time, just less confusion. So the 20 and the 50 moving day. So it's just a higher time frame, period of time, should I say. The 50 just viewed as so in this regard, 20 would be viewed as short term, 50 would be viewed as medium term. So short term euro, you can see was very still bearish. On medium term now, as you can see, 50 EMA, you can see right now we're coming towards the top. So again, like I said, if price closes above 1.125, potentially we could be seeing reversals on the cards. Go into our daily chart, and the 50 tends to act as nice dynamic support and resistance. Again, has all the same functions, they're just different periods of time. So some people like to use the 50 and the 200. So the 200 is known as your trend moving average. So it lets you know, it's not very accurate, but it gives you an overall view of the trend. So euro dollar is heavily bearish, as you can see from the big gap. When you go down into your weekly chart, you can see when euro broke 1.175, the 50 and the 20 was in the same place, which is a strong confluence, and you see we've been trading lower. Usually if price breaks through one, it tends to aim for the other. So if we break through and close above this 1.125 and above this 50 moving averages, you can see we haven't done that since July 18. So if we do that, then we do look like we could see a rally up to 1.15. On the daily chart, you can also see just the gap between. So it's just letting you know the trend, the overall trend. So you can see when we reject from the 200, the 200, the 200, the 200, it just lets you know the overall highest point in the market of where the trade would change. And as you can see, we've now closed above that 200. When you go into the 4 hour, same thing again, just acts as dynamic support and resistance. So me personally, I just like the 10 and the 20, as for me, they just react quicker to price, obviously because they're a shorter time frame, and just because the way I want to trade and the way that I'm looking for the turning points in the market. I'm not really interested in the macro direction when I'm just looking for, say, a 4 hour ABC or a daily ABC. I know I'm not going to be in the trade for that long, so I don't really want to overcomplicate it more than that, as it's relatively straightforward. So thanks for watching this episode, guys.